Hello, this is Donna Robinson, and I want to explain to you my concept of real-time market value versus appraised value. In the year 2005, we began to develop an eroding market, and I developed this chart to kind of demonstrate what happened here. In the early stages of the year, in January and February, real-time market value, that is the price that we actually expected to get for a property on the street, was keeping pace with appraised value, as it had been doing for quite some time. In a strong, hot seller's market where appraised values are continually going up some percentage, it's fairly easy to base your buy prices on an appraisal. But what we started seeing develop in March, April, and May of 2005 was a slight erosion in real-time market selling prices versus comparable sales demonstrated by the brown bar. Now what that means is that the appraisals that we were getting might tell us the property was worth $250,000, but in reality, in the real-time market, when we went to sell that property, we're having to cut that price to $240,000, $230,000, $225,000 in order to move that property. So this began to erode the market, and we began to see a decline in real-time selling prices, so that by August it appears that this is a bona fide downward trend. By the time Hurricane Katrina takes place in early September of 2005, it really deals a blow to the market activity, and so we see a tremendous drop, a very significant one-month drop in our activity in September. However, the interesting thing was that appraised values simply do not keep pace with those drops that we see in the real-time market, because appraisal data can go back as far as 12 months for its appraised values. So this means that it can take months or even a year to a year and a half for appraisal data to catch up to what is really happening in the real-time market. And we did in October. We saw a little bit of a bounce back to a more normal level of activity, but in November and December that slow erosion continued, so that now, coming into early 2006, real estate investors are in a very tricky situation. If you're buying based on an appraisal versus an analysis of real-time market data for your area, you stand a very significant chance of paying too much for your investment property. So what I want you to know is that buying right, especially for real estate investors, means knowing your real-time market value versus the appraised value and making adjustments accordingly in your buying strategy. Now, my program, along with real-time market value, shows you how to collect other key pieces of information that allow you to make the smartest possible buying decision by analyzing the fundamentals of your market, the things that are going on in that market that you cannot change, and then applying that fundamental data to your choice of strategy. This is all contained in my Real Estate Investor's Guide to Buying Right. I want to encourage you to check this material out carefully, because if you don't have a good understanding of how to evaluate your market and how to apply the fundamental details that go with any property to your choice of strategy, you could find yourself in a very difficult situation. So check out the guide, and I think you'll find the information to be very helpful and enlightening, especially if you're a new investor or an investor who's not quite sure how to adjust your strategy for a changing marketplace as we have today.